Hi, welcome to DayTradeToWin. Today we're going to take a look at some chart patterns that are formed in the charts as the forces of supply and demand fight for dominance. In an earlier episode in this series, we already looked at perhaps the most important pattern you can find in your technical analysis charts, and that would be a simple market trend with a series of higher highs and higher lows. That is also perhaps the most important pattern that you can find in the market. A series of higher highs and higher lows means you have a strong trend with pullbacks and continuation of the trend. And that is a perfect pattern to trade. And it is perhaps the easiest pattern to trade, especially for beginners. If you have an established trend upwards, you can enter your trades on the pullbacks, especially if you see a pattern in the volume with higher volume during up moves and lower volume during pullbacks. It's easy to enter a position on the pullback. You're going to enter the market at a discount compared to where the market has been trading recently. And you can keep a tight stop loss right under the support to keep the risk to the minimum. In a future episode in this series, I'm going to show you an awesome tool and a better strategy based on this setup that will make it even easier to trade trends. It's a strategy that I've been using myself in my career as an options trader, but today we'll just focus on the patterns in the chart and how we can trade them. Today I want to go through another chart pattern that we can trade. This is a pattern that is formed right at the end of an established uptrend, and it's a reversal pattern. The trend will reverse and a new counter trend will start, so it's the optimal time to be trading. This pattern is formed after a series of higher highs and higher lows, an uptrend. When that series of higher highs and higher lows ends and you'll get a new low to the same or at least the approximate level as the previous low, followed by a high swing to the same or approximate level as the earlier high, not the highest high but the one before that. So that's the pattern we are looking at today. This chart pattern is known as the head and shoulders pattern, and it obviously got its name because the formation looks like a head with shoulders on the sides, if you use your imagination. In my experience, if you want to use this pattern successfully, you should wait for the pattern to form and then wait for a confirmation of the pattern before you trade it. This will give you additional protection against losses. It will also give you an obvious optimal price level to place your stop loss order at, and you will enter at almost the exact same price as if you had entered immediately when the pattern was formed. Let me show you what I mean here. The series here of higher highs followed by a low to the support level and a high to the same level as before. This gives us the setup. This is the head and shoulders pattern. This gives us the setup, but we won't pull the trigger just yet. Instead, we note that the lows here form a level of support and we're now looking for this price level to break. In this type of price action day trading, we don't want to enter on the breakout itself. That can be done successfully in other strategies. It's a little bit more risky, but when we trade these chart patterns, we want to wait for confirmation instead until we enter our trades. Once the support level is broken, that is the signal to be ready. But we are not going to trade just yet. The breakout gives us the direction to trade. It gives us the heads up. We're going to go short, but we will wait for confirmation that the market is really heading downwards before entering our position. So how do we get that confirmation? Well, we want the market to break out, move lower on higher healthy volume, and then have a bear rally up to the price level that was broken, the old support. This rally should be on lower volume, which would tell us that not as many buyers participate in the rally. The demand is weak. Now if everything goes well and this is a successful breakout, a successful head and shoulders pattern, then the rally is going to reach the price level of the old support and then die out. This is the optimal time to sell short. You will place your stop loss above the old support line, which is now actually a resistance line. You will very often see that old support becomes a resistance after a breakout. So what this means for us is that if the market is able to break through this resistance, then we are proven wrong. Then the market proves to us that our call to go short was wrong, then we are stopped out and will live to fight another day. On the other hand, if the head and shoulders pattern is successful, the market will now start moving downwards, away from our stop loss, away from the level of resistance, and that means we're going to make money as a new downtrend has officially started and we're going to see lower highs and lower lows ahead. We can then trail a stop loss above every lower high as the downtrend continues. If you want to become an expert in price action, I suggest that you should practice a lot. We have a free day trading simulator on our website with free live real-time market data and possibility to paper trade without risking real money. So go to daytradetowin.com to start using it today. Please make sure you subscribe to our YouTube channel by clicking here. And make sure you watch all the episodes in this playlist to become an expert in price action trading. That's it for today. Until next time, good trading.